Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is December 13th, wow, almost the end of the year, edition of Market Outlook. Don't forget to sign up for this by going to our website, and that's at www.marketgauge.com, and you receive this free commentary and video newsletter free every week. All right, well, quite a interesting week. Lots of volatility, uh, change in direction, and looking a bit ominous. So let's get into this right away. First of all, last week we had noted that we were holding above the 50-day and the 200-day moving average, that we were in an accumulation phase, but that wasn't quite the scenario for much of 2013 and 14. As in August, we finally broke down, went into a bear phase, surprisingly recovered, almost tested the highs, and now have failed again. Couple points to note. Number one is that we broke between this converging 50 and 200-day moving average. So that puts us now, with Friday's close, into a bearish phase. And notice we did that on good volume. Another ominous pattern that has been evident for well over a year or more is that on major down drafts, huge volume increase, and similar action here on Friday, and that is not a good sign as well. So clearly a real deterioration of the primary trend here. Now, obviously, with this move here, most likely we won't have the inertia for the 50 to break the 200-day moving average. Now, we are at the lower end of the Bollinger Band, and we'll talk more about the absolute breadth and direction and sentiment as well. Let's take a look at the QQQs, because that was the leading index. And you can see the Qs, right, had gone into a full bull phase, actually ended up marginally closing to new highs, all-time highs, and by the end of the week, it also succumbed, but acting much better than the S&P. And as you can see, we are now testing the bull phase, going into what I would call a weak warning with this 50-day moving average so sharply up. So still quite a bit of a divergence, but really if you're looking at the fact that we made this high in July here in the Qs, followed by another marginal new high and barely a new high. Yes, on a closing basis one day, but really we gave up a good 4% just in the last couple of days. So again, under pressure here. We should be looking for some support in the Qs around the 200-day moving average, which is the 108 to 109 level. Well, exactly 108.80. But again, these are zones and not lines in the sand. So let's take a look at some of the market internals. First of all, you can see that both the up-down volume indicator, the advanced decline, and the McClellan all hitting, fairly deeply well-sold levels. Now, if you go back to late August on the big collapse, you can see that the absolute levels where we got on each one of these indicators was a lot more to the downside. So do we have a couple more potential jabs to the downside before we get some sort of relief rally? That certainly looks in the cards with the momentum as it's unfolding. A couple of things to point out is that there's options expiration, the triple witching next week, along with the Fed meeting. Then literally there's about $1 trillion of out-of-the-money options, put options, expiring. And so it could be interesting to see what happens on Friday along with what the Fed is going to do and just how much pressure could be put on the market. So there's some definite, very interesting convergences here of events all occurring at the same time, right? Options expiration, pretty much year end. That's a pretty important option solidification around that time period. So again, the triple witching, the fact that the Fed is making an announcement, and a couple of other things we're going to talk about in a moment. Let's talk about sentiment, and that's measured by options and volatility. This here is the ratio between short and 3-month volatility, 1 to 3 month. And again, we got a bit overbought on the absolute ratio, which is red. The other lines here are a 3-day and a 5-day moving average. What I do like to see is the moving averages cross above the absolute levels of 1.2, which shows some pretty extreme bullish sentiment. Didn't quite get there, but we did get there just on the absolute ratio on a closing basis. It marked the high. We're starting to get a little bit rich in negative sentiment here, but there's still plenty more to the downside possible. Remember, back in August, we got down to a level of about 0.75, 0.8, which is really quite a negative sentiment. So momentum clearly still on the downside. But if you look at sentiment and the market internals, they're both running pretty extreme, but with some more possible downside momentum to come as well. Again, first signs of upward strength here. This could be a washout. So let's keep our eyes on that as well. There is definitely cause for concern. Clear deterioration in the market on Friday, and by the end of the week we were down 4 or 5%, but more importantly broke some key support levels and moving averages. In addition, you have people like Carl Icahn talking about some of the issues around junk debt, and let's take a look at that as well. JNK. So we're going to take a look at some asset classes here. Look at this. So obviously junk debt in a scenario now that is wholesale liquidation. A couple of hedge funds that invested in junk debt are suspending redemptions. So the concern here is as this continues to spiral down with problems in the energy patch, right? A lot of debt, a lot of high yield debt was issued for oil and fracking purposes. That put, and those with the price of oil as where it is now at, I guess, around $36, $37 a barrel, that's beyond where these junk debt issuers can still make a profit. They are now turning severe losses into severe losses and have to potentially fail on their junk debt payments. So this could spread to other companies and other hedge funds that are engaged in trading junk debt. And the real concern is if certain people who are involved in those funds cannot liquidate and get cash out of those funds, they may find the only other place is equities that have not nearly been hit like this. In fact, equities are basically, if you're looking at the benchmark, the S&P, maybe down 2% for the year, not so bad compared to oil, which is in the high double digits. So big difference there. So we're keeping an eye on just how far this junk debt has a ripple effect on other asset classes, including equities. So taking a look at, so we've covered the sentiment, we've covered the market internals. Another factor here is looking at the calendar ranges. So very interesting. This particular chart is showing the S&P, which is our broadest based index. And you can see a couple of things here. The thick green line and the thick red line is the 6-month calendar range. We're trading, when you trade above it, obviously a bit positive. The thinner line, the upper red and the lower blue, is the 1-month calendar range. And obviously there's several different patterns that you can look at between the 1-month, the 6-month, and the price behavior. But certainly what you can see here is that we closed on our lowest level since the mid part of, or beginning part of, October. But more importantly, the 1-month, right, which is the blue, trading well beneath it, and also the 6-month, plus that recent test back in November, we're now trading lower on a closing basis. So the calendar range scenario, lots of pressure. And again, with the issue of the Fed and the TLTs or bonds, how they're going to be impacted is an unknown. A lot of people think it's already in the market. Some people say it's an unknown because it's been 10 years since rates and the Fed has actually announced a net increase in rates, and it's a wild card. So you have two schools of thought here, but clearly pressure on the markets. You can see if we break it down, trend has turned negative for the broad indexes, the S&P. It's beneath all of the calendar ranges as well. So the sentiment also downward trending and not quite at a major extreme. So lots of converging factors here all next week. And it looks like we're going to be in for at least some really extreme volatility. Okay, let's take a look at some key ratios. One that I really like to look at is the TLTs versus the S&P. It also is almost like a market timing system. And you basically look at the ratio between the two, put in a moving average, and that gives you a bias of whether you should be long bonds versus short spiders, and vice versa. So the first chart here on top is in fact the TLT chart with a simple moving average. I believe this is a 20-day moving average. The other is the S&P by itself, again with a 20-day moving average. Let me verify that that is correct. Yes, 20-day moving average is correct. And we have the ratio between the TLTs and the spider, along with a moving average of the same duration. So when the red line is above the green line, that favors being long bonds, and the inverse is true. So you would be long bonds, short S&P. You can also use it as sort of a market timing system as well. So when it tells you to be in bonds versus stocks, you might just sell your stocks and be flat. At any rate, what's interesting, even in the face of the fact that the Fed is going to raise, you would think that it might have more of a direct impact on Treasury prices. But look what's happening here. As the market's selling off, TLTs are getting stronger, even as the Fed potentially is announcing this week. Either that, or this is predicting that, in fact, you're not going to get the rate rise as expected. But nonetheless, just off of this market timing or this particular indicator, you can see it's indicating very strongly over the last couple days to be long bonds and short the S&P. Not a bad scenario. And this had been a pretty good timing mechanism overall for the market the past year. We're going to be using this more and more as the year unfolds, and certainly for next year as well. Let's take a look at gold using the same type of analysis. And again, when I put in gold relative to the S&P, you can see that gold had been really underperforming relative to the S&P up, and right this week we're basically touching that moving average of the ratio on a 20-day basis. And in fact, you might say that we had closed, I would say, just really on it. So next week, I'd really like to watch what happens here. Obviously, what's happened is gold basically found some sort of bottom as the volatility and the sell-off really gathered steam in the S&P. So gold as an alternative holding to the S&P, definitely showing some evidence here. Let's see what happens. Also, it would be nice to see if this gold can really close strongly above its moving average. It started here just on Friday, so you got some signs here as we're breaking down in the S&P and basically holding and moving up in the gold. The relative performance in this nervousness is definitely indicating a potential upward move in gold, certainly relative to the S&P, as its momentum seems to be continuing on the downside. Let's take a look at another end of the market. Let's take a look at currencies. I had pointed this out last week, and again, the euro really did well over the last 4 or 5 days as the market hit some pressure. So clearly, the euro versus the key moving averages here, we have above the 108 level. That would be a move over the last couple of days action, and a couple days above 108.30 in the FXE would definitely point to a potential trend change in the euro, potentially a double or sort of a compound bottom here that started last March. We haven't really been able to break down beneath par, and we've actually held around the 102 to 103 level, and now it looks like it's turning. So again, a move above the 200 and the last several months worth of action going back to late October would be really good for the euro. So we have a couple of interesting macro plays here potentially panning out, right? The fact is that there's this renewed pressure on the S&P, and certainly let's just go back to that and see where we might project a sell-off down to. If you look at the S&P, we're looking at some support. There's let me play around with a trend line here for you. And if we actually use the trend line from the lows, there should be some support approximately down into the mid 190s here. So, you know, you're still talking about a 2-3% sell-off here for the S&Ps, right? You've got a decent trend line off those lows. We certainly made a series of new highs. So I could see certainly getting down to that support level here in the low, and even a penetration of this this particular trend line here. You're talking about the 196 level, but certainly there should be some level of support around the 190s. But again, you just never know how far these things extend under pressure. With the mitigating factor that we are already on market internals and sentiment getting or at oversold that can get more oversold. So not quite at the extremes that would indicate a complete washout already. All right, that's it for now. Hope this helps. See you next week.